Information is the ultimate currency. For a decade, Zillow held more of it than anyone else in the residential real estate market. Their Zestimate was the digital oracle, a tool that transformed the opaque world of property values into a transparent, data-driven landscape. But in 2018, the Boardroom decided that knowing the price wasn't enough. They wanted to the price. Today, we deconstruct the algorithmic arrogance, the high-stakes gamble where a data titan believed its code could outmaneuver the physical reality of bricks and mortar. Zillow began as a lighthouse, guiding buyers and sellers through the fog of real estate data. Their platform was an advertising juggernaut, a high-margin business with low risk. However, the allure of the iBuyer model, instant buying, proved irresistible. The strategy was bold. Leverage their proprietary data to buy homes directly from consumers, renovate them, and flip them for a profit. They weren't just observing the board anymore, they were attempting to automate it. But there is a fundamental difference between predicting a price and capturing a profit. The Boardroom's pivot was predicated on a single, hubristic assumption, that the Zestimate was infallible. If the algorithm could predict a home's value within a narrow margin, then Zillow could theoretically scale the fix and flip business to a national level, removing the friction of traditional real estate. In 2018, Zillow Offers was launched. The mission was aggressive expansion. By removing human emotion and local real estate expertise from the equation, they believed they could achieve a level of operational efficiency never before seen in the housing market. Capital flooded in. In cities across America, Zillow began buying hundreds of homes a month. The data streams were clear. Volume was the metric of success. But in the pursuit of scale, the Boardroom overlooked the complexity of the physical world. This is where the strategy fractured. An algorithm is a map, but the map is not the territory. Zillow's model was expertly tuned to market trends, but it was blind to the physical friction of the industry. The first fatal error was the supply chain. In the wake of the pandemic, the cost of lumber, copper, and appliances didn't just rise, they became unpredictable. The second was the labor shortage. An algorithm can calculate the average cost of a kitchen renovation, but it cannot find a plumber in Phoenix on a Tuesday morning when every other contractor is booked for 6 months. As renovation times stretched from weeks to months, Zillow was left holding stale inventory. The data streams show the disconnect. The green line of predicted profit was being cannibalized by the red line of carrying costs and surging renovation expenses. The model was built for a frictionless vacuum. It was operating in a world of grit and delays. By mid-2021, the system entered a death spiral. To meet the aggressive acquisition targets set by the Boardroom, the algorithm began to overbid. It was buying houses at the top of a cooling market just to keep the machine fed. Zillow was now in a volume trap. The more they bought, the more they lost. They were overpaying for assets they couldn't renovate fast enough, in markets they didn't fully understand on the ground level. The model had broken. It was no longer a tool for profit, it was a vacuum for capital. In Q3 2021 alone, Zillow purchased over 9,000 homes, even as the red flags on the balance sheet were screaming. The algorithmic arrogance had blinded the leadership to a simple truth. You cannot automate away the complexity of a physical asset. The end was swift and brutal. In November 2021, Zillow CEO Rich Barton admitted the model was fundamentally flawed. Zillow Offers was shut down overnight. The result was a catastrophic $500 million write-down on the value of the homes remaining in their inventory. But the cost wasn't just financial. To stem the bleeding, Zillow was forced to lay off 25% of its workforce. 2,000 people who were the collateral damage of a Boardroom Gambit gone wrong. The company that sought to revolutionize the housing market was forced to sell off thousands of homes at a discount, often to the very institutional investors they had hoped to outcompete. The Zillow blunder is a cautionary tale for the age of automation. It proves that while data can aggregate human behavior, it cannot replace human experience. An algorithm can predict what a house is worth, but it cannot paint a wall, negotiate with a contractor, or understand the psychological nuances of a local neighborhood. In the Boardroom Gambit, the most dangerous move is believing your model is more real than the world it's trying to measure. Zillow remains a giant of data, but they have learned $1 billion lesson. Some markets cannot be solved with code alone. Join us next time on the Boardroom Gambit as we deconstruct the collapse of a tech unicorn that promised to disrupt the very blood in our veins. If you value strategic analysis over market gossip, like, subscribe, and share this breakdown.